Alrighty guys, welcome to a new video. My name is Ruben, and if you're new here, I trade a macro inversion fair value gap model. So I thought today I'd take you through a small PowerPoint, and this will be available for free if you join the Discord, or for free. Send me a DM when you join, or tag me in the main chat, and I'll send this PDF to you. But with that being said, let's get into it. I want to talk about two things: macros, inversions, and how to pair them together. So again, a lot of people ask me, they say, Ruben, what is a good inversion fair value gap? And I say, really, there's different types, right? There's different types of macros, there's different types of inversions, just like there's different types of PD arrays that ICT teaches. So an inversion fair value gap is simply just a price signature. And I've tried to make this PowerPoint as simplistic as possible, just getting the main points out there, the main points that you can use to study in the future. So in my eyes, there's two things, right? There's a normal fair value gap, a normal inverse, and there's something I like to call a change in the state of delivery inversion gap, right? So if you want to learn about that, if you want a video about a change in the state of delivery and how that pairs with the inversion, I'll make a whole in-depth video about what is a CISD, how to identify them, and which one's a higher probability one. But with that being said, I want to get into some of these examples. And first, let's talk about the normal inversion fair value gap. Nice and simple. Have a look on the screen here. Now, for most people, when you're learning these PD arrays, whether it's a fair value gap, a BPR, an order block, it can be confusing. So the reason why I actually chose inverses and the reason why I chose this and macros is because it allowed me to have a time element being the macro and the price element being the inverse. If you look on the screen here, I've got a orange circle there and an arrow pointing. You're probably able to identify more than one PD array. We do have an inverse gap. We do have that there. But also we have an order block very soon after created, about 3-4 minutes after. So just know that multiple PD arrays will overlap, but I've just chosen to use inversions because I find them easier and I find there are more than ample opportunities to take advantage of the market with this PD array. So that's number one. It's a normal inversion gap. We've got a bullish gap here. We close below it. It's a normal inversion gap. Number two, let's get into it. This one's a special one, and I would say that this is a higher probability inverse gap. So a change in the state of delivery, essentially, if you look at the example, notice how there's a set of up close candles, a set of up close candles, and a down close candle that sweeps the blue line, which is the buy side liquidity. So up close, up close, up close, up close, down close candle that sweeps the buy side liquidity. Now, for me, yes, you could enter just off the inversion. That's fine. But if you want further confirmation, and I mentioned this to my premium mentorship students in the Discord, you have to wait for that change in the state and you put your stop above the bodies at the top here, right? This is like a double confirmation. So compare the two. This one here, by the time we form the inverse, we do not form a change in the state. We would have to close below the up close candles before that inverse gets created, but we don't do that. In this example here, we've got the up close candles, we sweep liquidity, and we create an inverse, and we create a change in the state of delivery. And this is one of many, we'll talk about a few things, but one of many things that comes into taking these high probability trade setups and distinguishing what's a good inversion, what inversion's good, what's going to work out, what's high probability. These are the things to keep in mind when you're trading. And that's why I've got 2 times confirmation, like 2 times confirmation times 2 confirmation. It's when you've got combinations of things aligning. And ICT's talked about this. I've talked about this. Other YouTube creators have talked about this. Twitter, whatever you're involved in, people talk about waiting for multiple PD arrays to line up. And a lot of the time, there's a higher time frame context, which we're going to talk about in just a second. So again, just write that down. And I would find examples of these things in your own charts to talk about actionable steps at the end. But for me, there's 2 basic types. There's more than this. I can make a further video, but I wanted to make this nice and short and sweet. So the normal inverse and also the change in the state. This one being better than the first. So write that down, keep that in mind. But here's the big question. Heaps of people ask me, heaps of people on YouTube, in Discord, any social media context, even people I teach personally, which inversion fair value gap should I use? And people might come to me and say, well, Ruben, it didn't work out. I had an inverse, I had a change in the state, I had a breaker block, I had all these things lining up and it still didn't work out. It still didn't work out. How can I increase my probability? How can I increase the chance that my trade is going to be favorable? Because a lot of people, and this might be you, if you're listening to this video, this could be you where you're at the stage where you're able to identify these things. You're able to identify what an inverse is. You're able to identify what's a market structure shift, what's a sweep of liquidity. You know that. You can identify these things, fair value gaps. But the middle point, which a lot of people struggle with, is despite being able to identify these things, you struggle to identify which inversions are going to be higher probability. And I want you guys to write these 2 words down. This is all you need. This is all you need. 2 words. When, number 1, and where, number 2. Now, when is as simple as waiting for the macro. Now, macros exist every single hour. Write this down. 10 minutes before and 10 minutes after every single hour. And a bit later on in this video, I'll show you a few case studies. One from today, I'm recording this on the 30th of the 5th, but one from yesterday with the Discord. Both favorable, both really nice trades, and we're using this context. When equals the time, which equals the macro. Therefore, you put it together, right? You want to see this happen, you want to see that happen inside of a macro, which is represented with these 2 vertical lines. Number 1, so time, macro. Number 2 is where. So those are the 2 words, right? When and where. When we're talking about where, I want you guys to look for things. I want you guys to look for a sweep of liquidity, and I want you to look for price delivering from a fair value gap. Sweep of liquidity and ideally delivering from a fair value gap. If you have none of those things, it's probably not as high probability. So if we go back here, you can see we have that sweep of liquidity, we have the macro, we have the inversion, we have the change in the state. Beautiful. Go back here. We have a macro. Go back on your charts yesterday on the 29th. Have a look, right? This is the 150 to 210 macro London session. We have the macro, we have the sweep. We also had SMT, which I can make a video about in the future. Let me know in the comments below. And essentially all these things combined, when and where, this is what makes an inversion gap high probability. So for example, put them together. You could have this set up here that's outside of a macro that hasn't swept liquidity, and it's probably not going to work out. You could have this set up here that's just a normal inverse inside of a macro. It's got SMT, it's delivering from a fair value gap, and it's probably going to work out more than this one if it doesn't have that contextual nature to it. So just keep that in mind, guys. You have to have these 2 things combined. When and where, they're like pillars of macro trading. When should things happen, and where should things happen? And let's actually look at a chart example here from yesterday. So take a look at this. I've annotated the whole thing. I'll talk you through from left to right. We'll go in a little bit more detail, and then I'll talk you through an example today that I called out for the Discord. Once that's done, I'll give you guys some actionable steps. Again, if you want to join the free Discord, the link that is in the description of this video. Feel free to do that, but let's get straight into the charts here. So, not too sure if you guys can see my cursor, but have a look on the left-hand side, have a look at the bottom too. Just make sure you can get familiar with the time. So at the bottom, you can see the times. All those times are in New York time. I'm from Australia, but I still use New York time. Really important. Now, looking at the charts here, I want you to see all the vertical lines that I've marked out. The first set of vertical lines is 150 to 210. The second is 250 to 310. The third is 350 to 410. And the fourth, right on the right-hand side of the chart there, is 550 to 610. 3 of these macros are inside of the London Open session. The last one is not. But each of these offers a unique opportunity using macros and inversion gaps. And I want to talk you through it. So have a look at the first 2 set of vertical lines here. And notice I've marked out a few things, right? We've got a sweeper buy side, we've got SMT, we've got low resistance liquidity. Pair these things together. We've got an inverse, we've got the macro. If you want to wait for the change in the state, you can wait for that. That was this example right here, right? Coming back. That was this one. So you can wait for that, and then you target all this low resistance, which is labeled in red. Moving on to the next macro, we have a sweeper sell side. We have an inverse labeled in orange. We have 2 options. We have the first inversion gap. We can wait till it trades back into it, or we can wait for the third inversion opportunity, right? So realistically, at about 3 o'clock, at about 3:30, it doesn't matter too much, right? You can use what the macro has done to then take a trade. You can enter inside the macro 5 before, 5 after, 10 before, 10 after. It's really a matter of what do you expect price to do. But if you can use the macro, and again, 5 before and 5 after, it's overall probably going to be better. But there still will be setups that occur 10 minutes before. And yes, I would still take those. If all the other elements here, I would take it. If the time's there, in terms of being silver bullet or London Open session, and we have this, but it's like 8 minutes before a macro, I'll still take the trade. That's completely fine. So we've got 2 examples here. You can see how the macro pivots. Write that down. Another important function of macros. We pivot here. We pivot in the next macro, 250 to 310. And then we have the 350 to 410. Beautiful, beautiful example. That's this one right here. That's this one right here. So this one here has a buy side sweep. And I want you to have a look at the charts. The 350 to 410 macro, the third set of vertical lines there. We sweep the Asian buy side. So again, let's extend this a little bit further. It's not just any liquidity sweep. Ideally, it's a session liquidity sweep, or it's a liquidity sweep that happens inside of a fair value gap. Write that down. We have a nice reversal here. We come back down. So we've had a shorting at the first macro, a long at the second, a shorting at the third. And then what does price do at 550 to 610? Maybe you can't trade the start. Maybe you've taken some losses. You want to mitigate that later. What I've actually marked out here is a previous inverse gap with a very light orange or yellow, if you want to see it that way. Price trades back into that. You can see I've marked out buy side just before that 550 macro at the end of the right-hand screen. And after that happens, price starts to sell off. So this is the framework, guys. This is the framework. This is the guide to trading macros and inversions. You're looking for liquidity, you're looking for macros, and you're simply waiting to see if you have that low resistance to target. These are some examples from yesterday. Now, what are some actionable steps that you guys can take after watching this video? Number one, I'd encourage you guys to hop in the free Discord. Plenty of information there, and check out the charting study section. I've done a little bit of hard work for you, right? On the screen here, I talk about collecting data. I'll do this. Go back and try to find examples of these inversion gaps, not just yesterday, not just today, not just last week. Go back and collect examples. You need hundreds, right? And make note of how often these A+ setups happen, and also how often these happen around a macro or after sweeping liquidity. Check out the other videos on my YouTube channel, plenty there, plenty of videos going through macros and inversions, but I want you guys to study this. It's a really easy method. And again, guys, if you want this PDF, feel free to join the Discord, send me a DM, tag me in the chat, and I'll send it to you. With that being said, guys, keep pushing forward. Peace out. Enjoy your weekends.